All right, we'll go ahead and get started. Good morning, everyone. My name is Amber Hoopery, and I'm the First Year Experience Program Facilitator here at ECTC. And joining with me today, I have Chuck Eads. He is the VP of Lending at Abound Credit Union. And for the month of October, we are focusing on financial education at ECTC, and we have partnered with Abound Credit Union to help make a lot of different possibilities available to you all in terms of just expanding your knowledge regarding your finances as students here at the college. So Chuck is joining us today in order to give you all a virtual workshop geared more towards credit and lending, since this is Chuck's expertise in baby, so to speak. This is his area. So he will be providing you all some very useful information. Feel free to leave your webcams as well as your microphones on so that you can interact with Chuck and chime in with any questions that you may have throughout the entire workshop or presentation. Additionally, at the conclusion of the workshop, I will be taking note of all of the students that have jumped on and participated in the workshop, and you will automatically be entered to win some ECTC and Abound Credit Union swag. So feel free, to stay on and participate and ask any questions that you may have. If you do not have microphone capabilities and you need to type a question into the chat box, I will be monitoring that as well for Chuck so that he can answer those questions in addition to any others that you may have. So feel free to chime in. And Chuck, I'm going to hand it off to you and you can take it from here.
All right, that sounds good. So this will be about the volume I'll be talking at today. So if you need to turn up your speakers or whatever, please go ahead and do that now. Generally speaking, you can keep it on mute. But again, as Amber said, if you have questions, feel free to unmute yourself. This works better for me and everyone I've found if it's more of an interactive and type thing where you can ask questions as they pop into your head rather than trying to remember them 3 or 4 slides later. So, and again, Amber can facilitate some of that on her side with some of the chat functions and things like that. I can stop at any time. I told her just to wave her arms and I'll stop talking and then we can do it that way. So again, welcome everybody this morning. I am really pleased to be able to do this. I've done a couple of these on site and with a couple other groups. But as you can see here, obviously I'm with Abound Credit Union. One of our huge pushes is around financial education. This is something that's really important to us. The ideas of budgeting, credit, and borrowing money are things even myself as Chief Lending Officer for the credit union, these are things that I wish I would have had more guidance on when I was your age, getting out of college, getting ready to enter the professional workforce. And all the things you'll need to consider from that standpoint. I think budgeting and I think borrowing money, probably a little simpler. Credit is one of those black boxes out there, those black holes that people know a little bit about through Credit Karma and so on. But I think there's a lot of misinformation and a lot of urban myths around credit and credit scoring as well. So we're going to dig into that a little bit. We're going to dig into, again, some budgeting and other things as well. So again, appreciate everybody's attendance here. If we have more jump on during the call, that is great. But the 3 main things that I want to try to cover this morning and give you a better understanding are around your budget and expenses, some easy and free, simple ways to track and kind of know what your expenses are, maybe some tips on how to categorize those expenses and make good decisions going forward. I think understanding credit and credit scoring, and we'll see the impact of credit scores on when you borrow money. This is something you can also talk with your parents about. We have also some adult literacy channels as well that we're working on developing because we feel even amongst the adult population of our community, there is still plenty of need for this here locally and statewide. So, and then again, working through borrowing money, we'll look at some examples of borrowing money and how interest rate and credit score can affect that. So to kind of broaden that a little bit, our goals here, to introduce you to the idea of saving, paying off bills, opening a checking account, understanding checking, savings, understanding what a debit and a credit card is and what the difference is. We'll look at some examples around buying or financing a car, building credit, especially if you're young, especially in the state of Kentucky, you have to be 18 years old to legally contract or borrow money on your own. And so many of you may just be that age or even a little younger. So understanding how to kick that off and get started is important. So again, by means of introduction, my name is Chuck Eads. I'm Chief Lending Officer at the Credit Union. I put my education on here kind of as a joke because one, I don't work in my field at all. I never have, and I put that on there. But really more importantly, just kind of talk through, and I have a question on here about were my college years kind of like the Big Bang Theory TV show. I hung around with a lot of math and physics folks, and yes, it was kind of like that. But the bigger point here is that the process of going to college has changed since I went to college 30 years ago. Yes, that puts me in my early 50s. And the idea of a standard 4-year degree, what you're doing right now through ECTC will also open doors for you in the future. We just want to make sure that you have information to make sure you're making good decisions early on in your life. Again, even me personally, I wish I'd had a lot of this information when I was your age. So we want to talk through first some basic steps that we're going to be going through today. One, what's behind your financial decisions? Temet nosce is Latin. It means know thyself. And we're going to take just a minute to talk about understanding what your financial situation is, because it is different than everyone else that you know. It is different than your parents. And it is important for you to understand inside out what you're spending money on, where you can perhaps cut back, and so on and so forth. We'll get step 2, we'll work through getting organized, some tips to manage your financial documents and your time. Step 3, knowing where your money goes, kind of goes hand in hand with number 1 and number 2. As we continue down here, shopping smarter, finding money without actually making more, finding ways to save money. And whether that be coupons or anything like that, I certainly use those even at my age. Review and reduce your debt, building a strong credit report. Those 2 things go hand in hand, but we're going to talk through the importance of doing that, especially as you get older, as you get out of school, once you have a job in your field, understanding some ways you can save yourself money on your existing debts, and just be smarter about the things you're doing going forward. And we kind of wrap up for our goals here today as far as details, saving for your future. Setting financial goals, talk a little bit about goal setting and SMART goals and how to do that more effectively, creating a spending plan and investing money to reach your goals. So a lot of stuff. I'm going to move quickly through this. Again, I'm definitely open to conversation / interruption, however you want to do that. I would encourage questions at any point along the way. So this next slide really talks about getting organized. So again, knowing yourself, knowing your expenses. One of the best ways to do that, and it probably goes without saying, but setting up a checking and a savings account if you don't already have one. So you can walk in and you can cash your check from your job if you are working during school, which most people are these days. My daughter did so as well all the way through college. Setting up direct deposit for your income, requesting a debit card for your checking account so that all your expenses are visible. When you pay cash for something, while that can be good, it's also not visible going forward. You'll have trouble understanding what you're spending and what you're not. And we'll talk about that here in just a second. Setting up online banking. So again, I can log into our website. Obviously, I work here. I bank here at the Credit Union. So I can go in at any time and I can see pending transactions for my account, transactions that have come through my checking account. So I know exactly where I'm at any point in time. And again, we've got a great new website actually that just came out about 2 months ago for an online and mobile banking platform. Again, just to be clear, I should have said this up front. This is not a commercial for the Credit Union. This is really just our desire to get information out there to help everyone going forward. So we will reference features that the Credit Union has and things like that you can access later. But I just wanted to make that clear. So some checking account basics, again, paying bills, earning interest, direct deposit. We talked about those a second ago. Fees and requirements. Every financial institution is required by law to post a fee schedule so that you understand what fees and other requirements you have around basic checking accounts. Not all of them are free. And so why would you want to pay for something that you don't have to, especially if you're on a limited budget, right? But again, these tools offer you visibility on your spending and what you're doing on a day-to-day, week-to-week, and month-to-month basis. So, as I look at this slide here, again, free is better. Don't pay pay for things that you don't have to. And again, the credit union is not unique in that. I think we have a great checking account. But at the end of the day, if you're banking with another financial institution, just make sure you understand what fees and requirements, minimum balances, and things like that for your checking account as you go through your day-to-day activities. So one concept.
Chuck, quick note too. I was going to say I'm very glad that you put the fee for using ATMs on there.
Yeah.
On that slide, because I've even heard students say that within the lift that they had no idea that there were fees associated with using other people's ATMs before. Yep. So that's a really common misconception. So that's something to keep in mind.
Yeah, and so again, that comes back to if you walk into any financial institution, they should be able to provide you what's called a fee and rate schedule, which tells you the fees for ATMs. For overdraft, if you would happen to spend more than what you have in your account, most institutions offer programs where they'll cover that short term, and there's a fee for that. But you want to understand what those are and how those services work, because if you don't understand that, those kind of fees can pile up on a monthly basis. So I appreciate you throwing that in. That's just another good example. And kind of moving into this, I mentioned earlier setting up your checking, savings, and for me, it's especially effective on checking because I can see my paychecks come into my checking account and almost all of my expenses, except for, even my car payment, my mortgage, and so on that are with the credit union, come out of that checking account. So I have very good visibility on what I'm spending every day, every week, and more importantly, don't laugh too loud at this, but I can also have visibility on what my wife is spending. That also comes out of that same account. So at any rate, one of the concepts here, and again, I use a debit card for that. These funds draw directly from your checking account. So you are spending your own money in this case. So that's how a debit card works. Again, comes out of your checking account. You can fund your checking account from your savings account. You can obviously transfer funds over. But it's worth talking through that a credit card works a little bit differently. So these are funds that you're borrowing. An institution will give you a credit limit, let's say $1,000 for a student, where again, when you use that, you swipe it, you owe $100 for books and things like that, so that you then owe $100 on that credit card that you can pay back all at once, which I always encourage, or you can pay back over the next several months. You do have the flexibility on that, as opposed to using your debit card, where if you swipe it on your debit card, that $100 comes out of your account right away. And so there's really no option to delay that. Now, we'll talk a little bit later about delaying things and accumulating debt. You want to try to keep a good balance between what you're doing there. So again, just important to understand the difference between a debit and a credit card. A debit card basically uses your money, and a credit card basically uses our money, and you pay it back to us on a monthly basis.
Hey, Chuck, I've actually had a student just send me a message. She wanted to know why some financial institutions will charge you for using your debit card. I'm assuming running as debit as compared to credit.
Yeah, so there's a lot of confusion around that. And the thing that makes it even tougher is that every retail establishment processes these differently. The basic answer to that, and we do charge a fee on that for some PIN-based transactions where you actually have to put in your PIN. What we recommend is that you run those as signature-based. You have the option. I know at Kroger, when I do that, I just push the green circle and it automatically processes as credit instead of debit, and I don't get charged the fee. But basically, it costs us more to process a transaction in that way. And so we don't get as much income. This is probably a whole different topic for a different day, but every time that you swipe your credit or your debit card at a store, we get a small percentage of that for handling the transaction and actually taking the financial risk on that, should there be insufficient funds and things like that. So it's called interchange income. It's actually a big part of the credit union's income, as you can imagine. We have 100,000 members, 50,000 of which have a checking account with us and use their debit card on a regular basis. But again, the short and sweet answer there is that we make less and or it costs us more to process transactions in that way. So we're just trying to balance out that cost a little bit. So that's a great question. So knowing where your money goes, this is equally as important. And we kind of touched on that earlier, but I use a program called Microsoft Money. It's actually outdated. I don't even think you can buy it anymore, but I have it on my computer because I've been using it for 20 years. But you'll see in the example I give in just a second, there are free options like Google Sheets, open Office Calc, and then I pay for Office 360 at home as well, Microsoft Excel. I don't use Excel, but we'll see how a spreadsheet can be used to first list all your expenses, and secondly, to help you manage and kind of group these expenses so they're it's easier to understand for you and more transparent on maybe some of the things you need to cut back on. So again, the point here, where did that $20 go? We talked earlier about when you pay for things in cash, it's really hard to track. And so one of the things that you can do if you have access to one of these free spreadsheets is go through your bank statements for the last couple months and literally just record every expense that you had that came out of your checking account onto this ledger or this spreadsheet, right? So we'll take a look see what that looks like. And again, I note here, past spending can be more accurate because you can't go back and change what you've already done. You can change your behavior going forward, and this may give you some ideas on how you can do that, or at least how you can better understand your finances. This slide, I hope you can see this all right. It's a little small on my screen, that's why I mentioned that. But basically, a basic budgeting spreadsheet for budget and tracking, you can see what I've got here. I've got these dates. This was stuff I put together last year. But it has the information on who I paid this to, how much I paid, and then this is an example. This isn't actually me, but I think you get the idea. And then a category like housing, utilities, food, groceries, eating out, and so on. So when you pick these categories, and then I actually have a column on here for want versus need. I think it's important as you're going through the budgeting process to be able to identify things that are critical expenses that you can't do without, and then that's your need items. And then your wants are stuff that you do, but you probably could do without. That's one of the things you really have to balance, especially as you're on a limited budget, is first being able to identify those wants versus needs. And then the tougher part is really to try to cut those down from your weekly or monthly spending. So again, what you can do with this information now, once you have it categorized in this way, or need versus want, is you can take it to this. So most spreadsheets offer some sort of pivot table abilities or the ability to aggregate these expenses. So what this does is it takes this, for example, car and gas, if you have that as a category on here, car, gas, these programs will allow you to simply total up the $22 and any other $18 that are showing on here. And it does that automatically for you once you set it up to do this. So now you've got to look at what you're spending on gas, insurance every month, your car payment, clothing, entertainment, and so on. So again, the key with this is setting up these categories or these row labels and then letting the software process this for you. So it's very transparent what you're doing on a month-to-month basis. So this is just, this is a kind of a watered down example. There's probably a lot of other things you can do here, but I think this gives you a good idea of maybe how to start with this and how to categorize some of these expenses. So again, $1,296 is the total outgo over the period that I tracked here on the spreadsheet that I input right up there. The other way you could do this is to kind of pivot or to group this information by needs versus wants. And here's what that looks like. And so again, it's critical, especially whether you live at home, which we'll talk about later, or you live on your own. It's really important that you understand what your basic need expenses are, because obviously that's what you have to bring home every month to kind of make things work out, right? So again, these are your core expenses, your must-haves. Your want expenses are miscellaneous things. You control these. They're extras, and they're things that you can cut out or not cut out. Again, my daughter always used to say, YOLO, Dad. She's saying, hey, you only live once. And I'm like, okay, I get it, but you're on a limited budget, so you need to understand my point of view on this too. As I try to coach her through growing up, she just graduated from college, so it's kind of good timing on that with this. I've actually sent her a copy of this presentation, so she probably never looked at it, but hey, that's what it is. So again, here, understanding your basic expenses by group and category, and understanding your basic expenses by what is absolutely critical versus some of the stuff that you may be able to do without if you need to. Say you take a week's vacation, you have a little less pay coming in per month or something like that. So hopefully that gives you some ideas on how you can better understand the money that you're spending. reducing the money that you're spending, not only on the extra stuff, but also shopping smarter. Things that you don't have to have, like coffee. I've got these coffee makers here at work. We provide that for free. I don't know if the ECTC provides coffee in the lounges and stuff, but these little Keurig things are pretty cheap. I get them for about 50 cents a piece, as compared to like $5 to buy coffee at Starbucks, which, don't get me wrong, that's good. But when you're on a limited budget, these are the types of things you kind of want to think through on a daily basis. Buying in bulk, the cost per item is decreased, and using coupons and weekly specials. I actually keep track of my points that I get at Kroger because it saves me on gas. Next time I go to fill up at Kroger, I save 10, 20, 30 cents a gallon. So understanding what kind of opportunities exist around that is really important. Okay, so let's jump into understanding your credit and reducing your debt. So these two things I have grouped together on this slide. We're going to talk a little bit about credit, what makes up your credit bureau. If you're young, 18, 19 years old, you probably don't have a whole lot in your credit bureau. But as you get older and want to buy a house or buy a car, understanding your credit and buying these things for the first time, granted, you have assistance from financial institutions like Abound and or your parents if they're well versed in these sorts of things. But at the end of the day, these can be some daunting processes for you if you're not familiar with what's going to happen during these processes. So these pictures I did not choose. I don't know where they came from. I don't know this person, but obviously he's got a smile on his face. And, when it comes to credit, I think the biggest thing is not really being surprised, understanding what a credit score is and how it can affect your finances, is really the critical thing to take away here. So a credit file basically is an aggregation of information about you that's provided basically by financial institutions that you have borrowed money from. So there's three primary credit reporting agencies in the United States. They are Equifax, Experian, and TransUnion. These can vary. Different financial institutions, for the most part, they report to all three, but some smaller regional and local banks may only report to certain credit bureaus. So for example, we had some issues a couple years ago when we were working with Experian as our primary source of credit bureaus because some of the smaller banks around here weren't reporting. And so one, that doesn't give you credit for the good credit that you have, but it also makes credit decisions more difficult for us when we're trying to work with you on a car loan, a credit card, or something like that. So we did make the switch to TransUnion. That is our primary credit bureau now. And again, when we pull your credit, it's actually scary how much information the credit bureaus have about you. But some basic things that we see in your credit bureau are your name, your address, your date of birth, and your social security number. So you'll need to provide those items whenever somebody is going to request a copy of your credit bureau. We also see alerts. The credit bureaus provide us alerts that let us know if your social security number that you used to get that credit bureau is not the same as the one they have on record for you. Your address is a mismatch. Why would we want to know that? We would want to know that because that could be indicative of somebody else actually using your information to apply for credit. They didn't quite get your social security number right. Maybe they missed your date of birth or your address, or they're applying for credit at a different address. Now, that's not intended to scare you as much as it is just being aware that we have ways of checking those things on our end to make sure that the social security number that you gave us is actually matching with what the Social Security Administration has on file for you. Public records, judgment, and bankruptcy. Hopefully you're a little young to have things like that on your credit bureau at this point, but we do see a history of those. Generally speaking, good credit stays on your credit bureau for about 7 years. So once you're done paying something off, it'll stay there for 7 years. Poorer credit, charge-offs, which is basically when you don't pay for something, and bankruptcy, judgments, things like that only last for 7 years as well. So they will fall off over time. So again, a credit is basically a snapshot of your financial condition. It tells us about any money that you have borrowed from any financial institution. And then, there's the thought of inquiries, right? An inquiry is where somebody takes a look at your credit. So understanding there's two different types of inquiries that we can get. to these credit reporting agencies. A hard inquiry means that we've actually requested and received a full copy of your credit report. And a soft inquiry is when we've just requested information specific to your credit score only. So a hard inquiry we would use, look at your full credit report. If we're going to consider you for a loan or something like that, we want to see all of your information. A soft inquiry that only provides us a credit score, we might use that to put together pre-approval offers and things like that, where we know that you have good credit. We send out 50,000 records to TransUnion, and they come back and say, basically, you've got 15,000 members with credit scores over 750. You've got another 10,000 with credit scores between 700 and 750, and so on. So it allows us to put together pre-approval offers that are more targeted towards our members that have excellent credit, and we think will actually qualify to get a loan here. So what information is not in your credit file? So information that is in there, like I said before, is really tied to money that you've borrowed from financial institutions, which is primarily who reports to credit bureaus. They talk about your payment history, how much you owe, what your credit limit is, and so on and so forth. What is not in there is things like utility bills, information, and payment history. So if you make your payment to AT&T or Verizon or whoever every month, you're not getting credit for that, generally speaking, in your credit bureau. Which is too bad. I think there's been some pushes in the industry to get that type of information reported to the credit bureaus, especially for young folks that are just starting out. But that's not in there. Again, cell phone checking and savings account information, your balances, those types of things. We don't have that information. We have it if you bank here, but we don't if you don't, and that information is not in your credit bureau. A detailed transaction history. So we can see if you have a credit card with a $1,000 limit and you owe $500, we can see that. We can see when you opened the card, but we can't see individual items that you've charged on there. So we don't really have that sort of transparency there, but we can see the basic information that we need, and we don't have information regarding your income. And so that's why we ask for that at the time that you're applying for credit. So when we put the income and that information together with your credit bureau, we'll see that here in a minute. That puts us in a really good position to make a credit decision for you.
So Chuck, are medical bills included in with your credit report in terms of if you have not paid a medical bill?
Great question. Yeah, and I should probably add that to the presentation, right? So yeah, if you have medical bills that go to collection, so you get the bill from the lab or the doctor's office and it doesn't go paid, you get the next bill 30 days later and the next bill and it doesn't get paid, what will happen then is they'll send that off to a collection agency. Most of those collection agencies do report to the credit bureaus. And unfortunately, we do see that sometimes is where a younger person will come in and apply for credit. They've never had any credit from a financial institution, but they may have 2 or 3 collections on their credit bureau, right? So depending on the amount, if they're medical, we tend to overlook those, generally speaking, from a credit standpoint. But if they are non-medical, such as a phone company, a utility company, or someplace like that, where maybe you moved from one apartment to another, you didn't quite tie up all the loose ends there, those things that we would probably ask a few more questions about or want to know some details on why that didn't get paid. So absolutely a great question there. So again, I think the general takeaway on credit scores is it's an indication to us of the quality of credit in the past. And higher is better. That's what you want to remember going forward. The scores generally range anywhere from about 350 up to about almost 900. And you can see kind of how this breaks down as far as exceptional, very good, and so forth. And we'll see how that affects loan rates that you get here in just a second. Some things that go into your credit score. One, obviously, is how you pay your bills. So I can see when I look at your credit bureau, if you've had a car loan for 12 months, with us or with any other financial institution that's reporting to the credit bureau, I can see if you made each and every one of those payments on time for the last 12 months. If you were more than 30 days late, that will show on the credit bureau as well. Most institutions offer a grace period of around 15 days. So you always want to try to make sure you make your payments on time. If your payment, is due on the first of the month, then you want to make it on the first of the month. Again, most institutions have a grace period of 10 to 15 days where you can pay and not be assessed a late fee. In that case, you're just fine. You pay on the 10th, you're all good. If you pay on the 20th, depending on the late fee and how that's disclosed, you probably pay a fee of, let's say, $25 or $30. But the late fee is the lateness of the loan payment is not recorded on the credit bureau until it gets 30 days late. So again, just because you receive a late fee doesn't mean that you're showing as delinquent on the credit bureau until it gets to be 30 days past due. And then we can see that on the credit bureau. We cannot see if you were 15 days late. It either shows that you paid it within the 30 days or it doesn't. And again, so we don't really have that information and we don't really dig that deep. Amount owed, utilization of available credit. This is probably the other one that I would say is really big. And the reason is because if you have a $1,000 limit on a credit card and you owe $999 on that, what does that tell us? From a lending institution standpoint, it tells us a couple of things. One, you're right at your limit. And two, as far as responsible financial management, people who are successful in credit and with budgeting are able to limit themselves on what they spend. If you're right at your limit on your credit card, that would indicate to a financial institution that you're not the one limiting yourself. What's limiting your spending is the limit that you're given by that financial institution. So how this affects your credit score is if you owe more than about 30% of the credit line that you have available. So again, if you have a $1,000 limit and you owe more than $300 on that account, that will start to decrease your credit score. As you approach 100%, that really starts to impact your credit score pretty severely. So we actually see folks that apply for loans that have never made a late payment in their life, but they have multiple credit cards that they're what we call maxed out, which basically just means that they can't borrow anymore on that card because they've reached their limit in all cases. So that's considered more of a credit risk when you're being limited on your spending by how much somebody will lend you, not what you're actually bringing in and what's going out on a month-to-month basis. So,
Chuck, I just had a question come in. She wanted to know if it increases your credit score when you pay things off early.
Yes. So a couple other things here on this, and I apologize because one of these things is actually duplicated. But other things that impact it, of course, length of credit history. So, statistically, if you've got a deep credit file, you've been in the credit file for 30 years, that gives us more to look at than if you've been in it for 6 months. But yes, paying things off early definitely helps because one of the things the credit bureau looks at is the proportion of your loan balances to the amount that you borrowed, even on a car loan. How quickly you pay that down does affect your credit score. But what I would encourage everybody to do as often as possible, and that's tough when you're in college, trust me, I get it. But when you owe something on a credit card, to try to pay that off as quickly as possible. You want to maintain your balance on that credit card at a very low level compared to what your actual credit limit is. So yes, absolutely. Even paying a little bit more each month on your car payment helps your credit score some. The bigger component, though, is how much you owe versus how much you can borrow on your revolving and open-ended credit plans like credit cards. So hopefully that answered that question.
Yes, thank you.
Yeah, I appreciate those questions coming in. So we saw earlier about some of the credit score distributions. Just to give you an indication on, nationally, and this information is a little dated, but you can see credit scores in the 800 to 850 range. Approximately 20 to 21% of U.S. consumers are in that range. 750 to 799, 19%. We tier our credit and our rates based on your credit scores. So again, down here is where you don't want to be. We'll see the impact of that here in a second. And the higher is better. And so that's what you want to remember here. But this just gives you an idea of where the general public is as far as credit. So why does this matter to you? Well, here's why it matters to a lending institution, and I'm going to move through this pretty quickly. But what credit scores actually allow lending institutions to do is predict their loan losses, which ultimately are the driver of what interest rates we can offer you. And this is how this works. So in aggregate, with large pieces of data, which the number of loans we have on our books right now is large, we can predict what percentage of these loans will default within a certain period of time based on the credit score ranges that those loans fell in when we did the loans. So you can see down here at the bottom, if you score over 800, the chance of default on that loan is 0.1%, or in other words, 1 out of 1,000. All right, so you work that all the way down to the bottom end of the scale, and actually credit scores go lower than 580, but our cutoff is 580. So if you score between 580 and 599, we know that the odds of default are 7.8%, or almost 8 loans out of 100 will default over the lifetime of that loan. So that's important to us because we take losses when loans default, and so we have to factor that into our pricing. So the key here is, again, very few loans at higher credit scores default, and a much higher percentage of loans default at lower credit scores. So how does this affect you? Why does it matter? This is probably hard to see. I'm going to try to point out some of the really the key points on here is this. So across the top here, you see our different credit score ranges. And what you see here for an auto loan, where an auto is 2017 or newer, you can see here if your credit score is over 740, the interest rate we can give you on a 60-month loan is 3.49%. That's a great interest rate. If you score between 580 and 639, in order for us to overcome potential losses at a 7% of those loans will default, we need to charge a 14% interest rate on that loan to make the numbers work over the life of the loan. And so you can see that's a huge difference, right? And so that's how financial institutions use your credit score to determine the risk and to determine your pricing when you go to do something like that. So what does this actually look like? So this is hard to see, but I'll give you the highlights. What this is a comparison between two $28,000 car loans, one of which is at 4%. And these calculators, by the way, are out on our website. So again, we have a lot of great information out there. If you're just curious what kind of monthly payment you'd be looking at, these are free tools for you to use. But the point I wanted to make for this is the first loan is a $28,000 loan for 72 months or 6 years at a 4% interest rate. Your payment is $438 a month for 72 months. The second loan is basically a different scenario. Again, the same loan amount, $28,000, 72 months, and a 14% interest rate. Your payment is $577 a month. So the point I would make here is, one, certainly I would rather have the $438 a month payment, but in the big picture of this, it's important to understand that $140 per month difference over a 6-year or 72-month car loan is about $10,000. All right, so think about all the things you can do with $10,000 by the time you get your car loan paid off in 6 years. That's pretty staggering. And I think the main takeaway that I want everybody to have here is understanding how credit works, what kind of things drive your credit score, and understanding what a difference it can make down the road. One of the things that we offer too here is free pre-approvals. When you get to the point where you have income coming in, you want to borrow money. We'll take a look at your application, your credit, your income, and we'll let you know what your situation is before you walk into a dealership and try to buy a car, right? I mean, if this person here knew that their payment was $440 a month and they were comfortable with that, that's one thing. But in many cases, they walk in with a $576 payment and they were maybe hoping for less. But what these tools and a pre-qualification allows you to do is have an idea of, if you're comfortable with $300 a month, you want to have a good idea of how much car or what price of car you need to be looking at before you even go on the lot. That way you're not sitting down in the finance office doing your paperwork and you get surprised when you wanted a $300 a month payment and it's $575 a month. Because instead of looking at a $15,000 car, you were looking at a $28,000 car, and your interest rate was 14% versus 4%. So again, knowledge is power. You want to prepare yourself with information, understand what your credit looks like, want to understand what your options are before you even jump into the process. So we're at about 40 minutes right now, Amber. Are we doing okay on time?
You're okay. Yeah, you're fine.
I got a few more things I want to cover here. Another is an example with a credit card, paying it off in 24 months. And again, these are all calculators that are available on our website. But basically, if you owe $4,000 and you can pay it off in here over 24 months by paying $186 if your rate is 11% versus $223 a month if your rate is 30%. And yes, places actually charge 30% on credit cards. So it's not all that uncommon. You walk into Lowe's, nothing against Lowe's, I shop there all the time. But if you apply for credit, even if you have outstanding credit, you may pay an interest rate in the 25 to 30% range, for that credit. So again, we have credit cards starting as low as 8.99%, again, for very high credit scores. And so, understanding what your options are, again, is really important there. I think now I'd want to move into, so you're young, you're in college. I was your age once, obviously, and I wish I knew some of this information going in that I know now. But some things that you can do to get started. And one thing my parents did for me was they put me as an authorized user on their credit card. What does this do? One, this gives you access to use the card without any financial responsibility. You are not responsible for making payments on the card. However, it will report to your credit bureau. And so this is a good way to start off your credit career, so to speak, by becoming an authorized user on your parents' credit card. You can ask them to put that on. That's something that most financial institutions can do over the phone with a little bit of information. If they already have a card with us or someone else, they can generally add you as an authorized user. It's a great way to start credit. We do also offer some very low limits, like $500 for students and or younger folks that have verifiable income sources. Again, starting slow, starting low. We may give you a $500 limit just for little expenses, gas, things like that. And so, starting low there is a great way to get started with your own credit. We just need to verify your income. Even if you have no credit, sometimes this is something that we can help you out with. Again, talking about paying off cards each month, stay at least under that 20% of limit. I mentioned 30% earlier, but either way, you want to try to pay the majority off of that every month. You're probably not doing yourself any favors if you get a $500 card and you spend $500 on it and it stays there for the next 24 months of your life. It won't necessarily bury your credit, but if you can get that paid off, $100 a month or whatever, you will certainly help your credit score if you do that. And again, making payments on time. Talked about late fees. 30 days late actually reports to your credit. And again, one big thing I put on here is you're getting out of school, you're changing apartments, you're changing who you live with, moving out from home. Make sure that your student loan folks and your credit cards and any other people that you borrowed money from, make sure you notify them of your address changes. That is the biggest reason that we see poor credit with younger folks, is because you just didn't think to notify everybody, especially like student loans, credit cards, and things, of your address changes. Your bills go to the wrong address. You forget about it. Boom, you're 60, 90 days behind. And then that's at the point where your credit score really starts to take a nosedive. Creating a spending plan, we've kind of worked through that. I'm going to work through this pretty quickly. But I think it's important to be realistic about your budget, stick to it. Again, we talked about needs versus wants and aligning your budget with your goals and values. And again, every month is different. You need a little bit of a cushion in there, on a monthly basis, just for unexpected expenses. So we kind of talked about this a minute ago. When you're looking to borrow money, what are some things that the lenders are going to look at, the financial institutions? They're going to look at the amount requested, your interest rate and term, monthly payment and debt ratio, credit score, and loan to value. So just real quickly, your debt ratio is basically the amount you have going out every month versus how much income you have coming in. Your credit score we talked about. A loan to value means how much are you borrowing versus the value of the collateral. So in the case of a car, if the car is worth $10,000 and you borrow $10,000, your loan to value is 100%. And so it's a little bit less risky for a financial institution. If you go out and buy a $10,000 car and you have a $5,000 down payment, your loan to value is 50%. And lending institutions will look at that a lot more favorably. They're willing to take a lot more risk, especially if you've had some credit issues in the past, if your loan to value is very low. If we were to happen to repossess that vehicle, we probably would not take a loss on it. So some numbers, given that what we just talked about with your budget and what lenders look at, some general rules of thumb when we see applications for credit are an auto loan should generally be no more than 15% of your gross monthly income. So again, this example here will assume somebody with a $3,000 per month income, and I get that most college students don't have that. But just, think forward thinking as you move out of college and into your professional career. 15% of that is around $450 per month. And 45%, which is your total gross monthly income debt load as a percentage, that would be $1,350 each month in total expenses based on a $3,000 a month income. So from a lender standpoint, that has to include your rent, your car payment, your credit card payments, student loan payments, and all those sorts of things. We don't consider gas, insurance, and other things like that. Those ratios are based off of what information you owe money on that we can see in the credit bureau. And so that's why it's only 45%. The average person probably brings home 80 to 85% of their gross paycheck. So that leaves you some room for, again, insurance, gas, food, and those types of things that really aren't shown on your credit bureau. So again, I mentioned mortgage in here when it's time to buy a house, but these should give you a general idea of maybe some things as far as responsible loan monthly payments that you can have depending on what it is that you want to buy. So again, if you're making $1,000 a month, $1,200 a month, these can still apply. You can do the math pretty easily on that. All right, so we talked a little bit about budgeting, some of the basics here, kind of as a recap. Making sure you understand what your wages and tips from work are, including any cash that you get, any benefits that you get, health insurance, things like that, income, child support, alimony. We consider those in loan requests, in interest and dividends. These sorts of things get a little bit into what we would see on a tax return. We're not going to jump into that today. But again, and we've spent quite a bit of time talking through expenses, rent, mortgage, electricity, water, utilities, those sorts of things. But getting an understand, again, of your income versus your expenses. Obviously, when your income does not exceed your expenses, that's when life can get a little bit tough. So one of the things we wanted to do here real quickly, and Amber, I'm going to try to wrap this up here in the next 3 minutes. That'll leave us a couple minutes for questions or anything else here, but trying to factor in. Yeah, go ahead.
No, I just said, okay, you're fine.
Okay, all right, thanks. So, one of the things you want to look at possibly, is trying to get through college, for example, paying your tuition, trying to minimize, certainly there are good student loan options out there, but, understanding what your tuition, your fees, books, supplies, room and board, those sorts of things are going in. And again, these things, room and board, again, that's different. I had on this scale here, if you lived with your parents versus if you're living off campus, right? So you want to understand the difference there. While parents can drive you nuts, they also can serve as a crutch financially to kind of get you through school if your goal is to try to get out of school, one, with a degree, and two, with as little debt as you possibly can. And then, so that's something to keep in mind there. That's obviously, there's a give and take there and sacrifices that have to be made on both parts. Again, living through with your parents, I think this is where it kind of goes back to what we talked about earlier. Understanding, for the most part, we see not a lot of parents charge rent. I mean, I get it if they do, but at the end of the day, understanding what your total expenses are, including your tuition, books, et cetera, per month. Other expenses, that's kind of your want category that we saw earlier. And then itemizing these out. We kind of saw earlier how you can better understand insurance, gas, food, utilities, those sorts of things. But here's where the rubber meets the road. These things total $1,177. You can cover that, including some other miscellaneous expenses, with about $1,200 a month in net income. That's about $1,400 a month in gross income. Before taxes are taken out. Again, net income is after they take out taxes. That's actually what you deposit into your account or what you take away each week or each month. So again, in order to get to $1,400 a month, you're talking about 30 hours a week at about $8 an hour, just to give you some perspective there. Most of you probably already knew that if you're working currently, but this is the type of information. If this is where you're at financially, then this is what you need to be considering as far as hours worked per week. And of course, you have to balance that out with your studies, right? And then the hourly wage that you would kind of need to compete with that. So if you're living on your own and you have $4,000, actually that should be 400, my bad. But when you add all these up, you have considerably more expenses, more in food, more in utilities, which I think were zero before when I used the living at home example. The total on those, 2227, your net income required is 2,300. Again, the gross income would be 28. That is about 30 hours a week at 16.15 an hour. Those jobs are not a dime a dozen. You want to keep that in mind. If you're lucky enough to find something like that, then that would allow you to perhaps live on your own. But again, you want to understand the difference between living at home, living on your own, and again, factoring in tuition, books, etc. To that, because again, a great goal can be to work yourself through college, get your degree, and have as little debt as possible when it's all said and done. I'm going to skip over a couple slides here about setting financial goals. I think everybody by the time you hit college has probably heard of the SMART basics of setting goals: specific, measurable, attainable, relevant, and time-based. Measurable is important. I would say the most important things there are being specific and being time-based, right? I'm going to skip over this, but essentially a good goal, well, let's start with a bad goal. My goal is to start saving more money every month. Good luck with that. I think again, you have to be more specific and put a timetable on that. This example was developed late last year, so it's probably a little outdated, but I think you get the idea. When you're specific and you say, I want to save $3,000 by 2022 or some date in the future, that's 21 months away. That's $143 a month that I have to set aside into my savings account, not even consider that in my income, my take home. If you get paid weekly, that's about $30, $35 a week that you would set into your savings account. That's how you would hit that goal. It's kind of like losing weight or anything else like that. If your approach is, hey, I just want to lose weight, yeah, you got to be specific. How much do you want to lose? In this case, how much do you want to save and by when? So again, be specific on the amounts, break it down weekly, and definitely put a timeline on that so you're accountable to your own goal at the end of the day. We've already covered that. I think I would just point out here, many of the things that we talked about here, we have tons of financial education information out on our website. Again, it's free to use. You can access it anytime. We have some great calculators out there that will allow you to kind of tinker around and play with some numbers. So you kind of understand how things work from a standpoint of borrowing money, what kind of monthly payment options you have. You can guess and estimated interest rates and things like that. Last thing, I guess, is just working through like some after graduation real life examples. And then, working with mortgage payment, car payment, again, by using these calculators. And again, a lot of success in life is driven off of making sure you utilize the resources that you have available. You want to understand if you can afford $650 a month for mortgage payment. You need to understand before you start the process of shopping for a house, what that means, how much house, what price of house you're looking for, when you take into account any down payment that you may have and things like that. So again, I would point out for $650 a month, that's a $110,000 loan, including insurance and property taxes. So you could buy a $110,000 house. The credit union has 100% financing options out there. So that means $110,000 borrowed on a $110,000 house. So again, the takeaway here is understand kind of what your options are, know what you can afford going in. If your budget's $650, there's no sense in going out and looking at $250,000 houses, unless you have $140,000 to put down, which most people don't right out of college or ever for that matter. So I guess at this point, Amber, I'm kind of to a point where we can pause. And I know I worked through a lot of this stuff quickly. It's a lot of information. I'm glad we recorded it because hopefully everybody will have a chance to maybe go back and watch it again. Or we're always open to questions right now. So I'll kind of pause here to see if we have any questions from the group.
So students, if you have any questions, just feel free to unmute your microphone if you have it muted. That way we can hear you.
We should have like some Jeopardy music or something going on in the
I
background.
know. Well, a quick
Uh,
question, Chuck, if students are kind of thinking on that, or maybe don't have any additional questions because you did such a good job as far as being thorough. But what I guess recommendations would you make as far as, some of our students that are working within their associate's degrees right now and will soon be transferring to finish a bachelor's degree? What are some small things that they could be doing right now to really just help set them up for financial success once they're graduating from college?
yeah, so that's a great question, and I would answer that a couple ways. One, obviously, some of the things that we talked about as far as understanding your finances, understanding your budget, those basics will definitely carry through once you're done with graduation. I think, believe it or not, I think one common thing that I see that I'd really try to emphasize, and I think I had a slide down here later, but as you work yourself into your full-time job, something within your field is, I hate to say it, you're going through college, right? You don't want to really think about retirement, but thinking long term, understanding in many cases you make an hourly wage or so much per week or month if you're salaried, but understanding what that looks like in 5, 10, 15 years, even by the time you're 60 or 65, you will likely sit through any number of financial education seminars on investing. One of the things that I would point to is that even I would admit that I waited too long to start investing in my retirement. 401k and other areas where a 401k, just in a nutshell, is basically where you contribute money and your employer matches that money to an extent and puts it in a retirement account for you. Now, there are penalties for pulling that out before you retire. That's certainly not the scope of this conversation. But the point I would make is, one, just understanding your finances, what your options are for a credit standpoint. And once you do get that job, start putting money away right away. Set a goal like 3 or 5% that you can set aside of every paycheck, because any financial advisor can tell you that really your payoff on that over 40 years is going to be 2 or 3 times what it would be over 20 or 30 years. I mean, it really does compound at that kind of rate. And so it makes a huge difference. So I think, again, understanding how to budget money, understanding what your income versus your expenses are, understanding credit so that you get the best possible deal and pay the least amount in interest when you borrow money, and really starting right away with kind of setting some money aside for either that safety nest or that safety net, from a financial standpoint, having a couple months of bills set aside in your savings account in case you transition jobs or something like that, and then really starting to set aside money for your future and thinking about retirement. It's hard to do when you're 20 years old. I get it. I really wasn't focused on that myself, but I think, looking back, in hindsight, I would definitely say those are some things that I would have really pushed harder myself on when I was your age.
Sure. And one thing too, students, to keep in mind, I actually had a conversation with another student about this the other day. So many students get into this challenging situation where they have unreal debt just as far as student loans. And so taking that a little bit from the education side, ECTC is a great start as far as a much more affordable education. But even whenever you're finishing up here, if you're planning on transferring to complete a bachelor's degree, there are so many scholarship opportunities out there in addition to Keys money, financial aid, you name it, to be able to get the majority, if not all, of your education paid for, where you're also graduating and you may not necessarily have 10 grand in a savings account ready to roll for you. But at the same time, you're not graduating from college with unreal debt to kind of begin your financial life. So that's something else to keep in mind as you kind of go through things, planning for the future.
Yeah, so Amber, I appreciate you mentioning that, because real quick, I will say that, as a group of people here that look at people's credit bureaus all day, every day, I think, one of the things that we notice also is, if you have, just for example, a state school, an in-state tuition school with room and board might run you, $20,000 a year. If you don't have a substantial amount saved, or your parents don't, for education, We see folks come out of school with $60,000 to $80,000 in student loan debt. And so that's one thing you definitely want to keep in mind. Again, trying to keep this simple. But again, you want to set yourself up for the future. But at the end of the day, you want to understand, like I think I had a slide earlier in the presentation that fits perfectly with your point, which is don't pay for things you don't have to.
Right.
There are opportunities for you to take advantage of grants and other things like that that will help you, scholarships that will reduce that amount. And it takes some research, right? You have to log on. You have to know where to find those. And Amber and the folks in administration and ECTC can help guide you on that. But that's big, right? You want to minimize the amount of cost. You want to get out of school with not only your degree, because I'm sure you've all seen the statistics on lifetime income for people with college degrees versus those without. And you couple that with, reducing your expenses going through college, getting out of college with your degree and as little debt as possible. You're really just setting yourself up for a great success going forward.
Great. Thank you so much, Chuck, for your time and presentation. We greatly appreciate it. And students, just so you know, we will be drawing for the individual to receive a stash of ECTC and Abound Credit Union swag, and I will be contacting you if you are the winner for that, and also posting that on our Win Center and ECTC social media accounts. So feel free to be following that and paying attention to that. And again, Chuck, thank you so much for leading this presentation, and I will share this recording with you all as well. That way you have it for Abound Credit Union's YouTube channel as well, and students will have that available for you too.
Yeah, thanks, Amber. And we appreciate the opportunity to do this. We think it's a social responsibility in our communities to make sure that people at least have the tools that they need to be more financially successful, right? So we have folks in any of our branches that you can walk in and talk to about some of these basic things, can help you get started on these things. Just encourage you to take advantage of those resources.
Sounds great. Thank you so much, Chuck. And again, if any of you all have any questions, feel free to reach out to Chuck or Abound Credit Union representatives, and you are more than welcome to go to their website at aboundcu.com in order to also see the other online learning modules that they have as well that are available to you geared towards financial education. So thanks again so much, Chuck. We appreciate it. And all of you all have a great day, and we look forward to seeing you next Tuesday at 11:30 for our workshop led by Mark Philpott to wrap up our financial education series of Adulting 101, Managing Your Money. So thank you all, and we will see you next week.
All right. Thank you, everyone.
Thank you.